All right, team, let's clear up one of the biggest myths in housing. Powell, the Fed, just cut rates, and headlines are everywhere. But here's the mistake. People instantly assume mortgage rates will stop right along with it. Well, that's not how it works. The Fed sets the federal funds rate. And, that's the overnight rate banks charge each other. Mortgage rates, especially the 30-year fixed, they don't move off that number. They move with the 10-year Treasury yield. Now, if you go to CNBC or Bloomberg, you'll see that 10-year yield sitting at around the 4% range. And here's where people get confused. Mortgage rates are sitting closer at 6 to 7%. So why the gap? It's called the spread. Think of the yield as a scoreboard. That's the baseline return investors want for risk-free U.S. government debt. But a mortgage is riskier. People can refinance, default, or pay off early. So lenders add a cushion, usually about 1.5 to 2.5 points above the 10-year yield to make mortgage-backed securities attractive to investors. That spread is why we're in the 6s and 7s, even though the yield is in the 4s. So you ask, does the Fed matter? Well, absolutely. A Fed cut signals tells the market the Fed is loosening up, which can shift investor sentiment and pull yields even lower. But the rate you and I care about, the mortgage rate, is ultimately determined by where the 10-year yield is trading, plus the spread. So here's the coaching takeaway. Don't just watch Powell's moves and think you know where mortgage rates are going. Watch the 10-year Treasury yield. That's your key indicator. If yields dip, mortgage rates follow. If yields climb, mortgage rates get more expensive. Bottom line, the Fed is like the coach making adjustments on the sideline. But the scoreboard, the 10-year yield, is what actually drives the mortgage market. So keep your eyes on the scoreboard, not just the coach, and you'll always stay a step ahead.